8 consecutive weeks. No correction. The S&P 500 is on its longest winning streak since December 2023, up 27.4% over the past year. If you have been waiting on the sidelines, you are probably asking yourself, is it too late? And if you are already invested, you are wondering whether to hold or take some profit. This video answers both questions with the actual numbers, not the noise. Start with the numbers, because this rally has real earnings behind it. NVIDIA reported revenue of $81.62 billion in the first quarter of 2026, up 85% year over year. Their data center division alone generated $75.2 billion in a single quarter, a record driven by AI training and inference demand that is not slowing down. Net income tripled year over year to $58.3 billion. These are not projections. These are reported earnings. And it is not just NVIDIA. 84% of S&P 500 companies beat their profit estimates in the first quarter of 2026, a remarkably high beat rate. Profit margins hit a record 13.4% across the index. More importantly, this rally is no longer concentrated in a handful of mega-cap tech stocks. Broader sectors and smaller market caps are participating. Treasury yields are retreating, which reduces pressure on equity valuations. The market is up because earnings are up. That is the foundation. Here is what those earnings numbers do not tell you. Valuations are elevated. The Shiller CAPE ratio, a long-term valuation measure, stands near 39. The forward price-to-earnings ratio is around 23 times, well above the 20-year average of 16 times. By most historical measures, stocks are priced for optimism. That does limit expected long-term returns from this level. It is not a crash predictor, but it is a caution signal worth understanding. A 15 to 20% correction is always possible. Analysts have flagged summer 2026 as a period of elevated risk. Never invest money you need within the next 3 years. But this is not the dot-com bubble. In 2000, the CAPE ratio hit 44, and the companies driving the rally had almost no earnings. NVIDIA earned $58 billion in net income this quarter. That is real revenue, not speculation. And the most reliable investing rule still holds: time in the market beats timing the market. No one consistently calls the top. If your investment horizon is 10 years or more, the best time to start is now. The second best time is also now. Here is what to do, based on where you are starting from. If you are already invested and sitting on strong gains, resist the urge to time the market. Consider rebalancing if your US stock allocation has drifted significantly above your target. Do not chase recent performance by adding more to what has already run hard. If you have been waiting on the sidelines, dollar cost averaging is your answer. Pick a broad index, ETF, VOO, or IVV tracks the S&P 500 at extremely low cost and invest a fixed amount every month for the next 3 to 6 months. You will not buy at the perfect price, but you will not miss the entire move either. On the practical side, you do not need a large sum to start. Fractional shares on Moomoo and Interactive Brokers let you own a slice of any S&P 500 ETF from as little as $5. For your brokerage account, all 3 of these are MAS licensed and support pay now deposits. Moomoo is the most downloaded investment app in Singapore. 0% commission on US stocks with a $99 platform fee per trade. Tiger Brokers charges 99 cents per trade. Interactive Brokers charges $1 per trade and offers SIPC protection of up to $500,000, the highest coverage available to retail investors in Singapore. Complete your W8BEN form during onboarding. Most brokers automate this. It declares your Singapore residency and sets your US dividend withholding at 30%. And here is a fact many Singaporeans do not know: Singapore has 0 capital gains tax. You pay nothing on your stock sale profits. The 30% withholding only applies to dividends, so if you hold a growth-focused ETF like VOO, the dividend yield is low enough that the withholding impact is minimal. If you use your supplementary retirement scheme account, check whether your SRS provider offers US-linked unit trusts or ETFs. You may be able to get S&P 500 exposure with a built-in tax relief benefit. So, which camp are you in? Already invested and wondering whether to hold? Waiting on the sidelines with cash to deploy? Or a complete beginner who has never bought a single stock? Drop it in the comments below. I read every one and it tells me exactly what to cover next. Subscribe if this helped, and I will see you in the next video.